And so in 1987, we have the Bank of England creating the London Bullion Market Association. And that was really the start of using these unallocated promissory notes to trade and set the price of metals.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And as we enter such a fascinating phase of the markets, lots of QE and rate cuts on the way, metals showing signs of life, while the stock market bubble continues to roar on. So fortunate and excited to have David Jensen join me today to dig into all these. David is the CEO of Jensen Strategic, a mining and precious metals consultancy. You can also find him at Real David Jensen on Twitter. David, was a pleasure to finally meet you in person and catch up with you at the Sprott show in Vancouver. And geez, you know even more about metals than I even thought from following you on Twitter. So pleasure to have you in here today. How's everything going, my friend?
Going well, Chris. It's great to be with you for this interview.
Yeah, well, certainly fascinating things going on. And right before we hit the record button, I like the sentence you gave me that was, as long as the physical continues to flow, anything can happen, because obviously, as we know, you have a lot of these things traded in paper. So perhaps just to kick things off, maybe an overview of what you see going on right now, and then we can dig into it from there.
Yeah, well, we've seen the price of gold and recently silver's surging in currencies other than US dollars until recently. And then now in the last month or so, we've seen the US dollar price of these metals start to move up as well. But as you and I have discussed over and over again, these are prices set primarily in London, that's the physical market, and in New York on the COMEX, but they're both trading these unallocated contracts, which are promissory notes. So what they are is promissory certificates of metal delivery, and almost anything can happen with the price as long as physical flows in London and gives the appearance of a real metal pricing, price discovery system. You can set the price wherever you want by issuing. Typically what happens is that these bullion banks issue massive amounts of contracts on gold and silver, and they know where the stops are in the market, and ultimately you can take out the stops of the various traders and investors and cascade the price down whenever you wish, as long as people are believing in the pricing system. So I look at the pricing system and the price that we're looking at as somewhat of a chimera. It's not something that reflects the true supply and demand structure for the metals themselves.
Yeah, that certainly is the case, unfortunately. I know there's a lot of debate about it. I have a friend who's a really good guy and a smart money manager, and he was saying the other day, well, we don't have proof until the SEC or the DOJ says it.
Yeah.
I think a lot of people see it that way, although, again, one of the reasons it's nice talking with you today is that I would say for folks who dig into it for long enough, which doesn't really take that long, whether the DOJ or CFTC says it, it's pretty clear. And maybe you could, for folks who might still be on the fence, or for the folks who are on board or wanting to know really how to take that information and use it, maybe you could put that into perspective so people can really understand why that is the case and what they can do in response.
Sure. Well, I guess the two primary markets are New York and London. And the COMEX in New York, if you look at the rule book, there are numerous provisions there for settling gold and silver contracts with cash settlement. Whenever the directors of the COMEX deem it to be fit. Mm-hmm. So. And ultimately, in terms of gold settlement in New York, it's 0.04% of all contracts traded in New York actually see bar settlement, physical metal settlement.
Can you repeat that number again so I make sure I heard that right?
It's 0.04%. So that's four parts per 10,000, right? I mean, it's a ridiculous number.
Mm-hmm.
So if you have 10,000 contracts, 4 of them will see a metal settlement.
Which, like you pointed out, can go on for a while until it doesn't. And certainly in the past, let's call it 2 or 3 months now, you know, off the bat, we've seen the prices actually rally, which, you know, gives us some amount of information. That doesn't say that we can't see silver smoked $1 or 2 lower in the next 10 minutes yet. On the other hand, we see a lot more interest. I found it interesting how the mainstream media, which, you know, again, you have Jeffrey Gundlach and Ray Dalio have been talking about gold for over a year now, yet all of a sudden it's being portrayed as the smart trade, which I would agree with, yet that's been the case perhaps for a while.
Mm-hmm.
But there's more people jumping in. We see these ETF reports, whether they're putting metal in there or not, showing now over 100 million ounces of silver added over the past couple months. So I've been wondering more and more if we might be getting closer to the point where someone or enough people actually show up and want their metals, and it creates a problem in this system. Where do you see us at in that spectrum?
Well, I mean, if I can just go back to how we got here in terms of the structure of the market, maybe we can feed into that, because I think ultimately we're very close to the end of the sustainability of paper.
Yeah.
Substituting for metal. But I mean, if you look back to 1980, they had a severe consumer goods inflation problem from all the money printing that went on in the 60s and 70s for the Vietnam War and for guns and butter, Lyndon Johnson. And at that time, the Fed funds rate, they had to raise it to 20%, so roughly 9% above the inflation rate. And the reason that they had to raise interest rates so high was that they needed to get people back into bonds again and out of the gold market. And so it caused a real problem there, because obviously there was a lot of tension in the economy from the high unemployment and the high concurrent inflation, consumer goods price inflation that was going on. And so in 1987, we have the Bank of England creating the London Bullion Market Association. And that was really the start of using these unallocated promissory notes to trade and set the price of metals.
Right.
And so, you know, the Bank of England created at that point. And what we see, I mean, there's some, I'll send you a chart, maybe you can post it during the interview here. We can see how the price of gold broke away from responding to the inflationary pulses. And that as a consequence, ever since that point in the late 1980s, they've been able to lower interest rates down to 0%. So essentially, if you look at it over the long period or the secular period, you can see that, you know, from 1980, we went from 20% to 0% in the last couple of years. But gold hasn't really responded that much. I mean, it had gone up from 1971 to 1981 by over 30 times. And that was what sucked all the money into the gold market. And since then, since 1980, gold is, you know, in US dollars, it's approaching twice the level of what it was at the peak. It's approaching 6 times what it was in 2000 when it bottomed at $250 an ounce.
Right.
But what allowed that drill down from 850 to 250 all the time that they were running in interest rates lower and lower and juicing the financial markets more and more was the fact that people were believing in and holding these certificates in London and New York. So this first started coming to light in 2010, and I there's a very interesting interview, a video record of the CFTC hearings in New York that were run by Gary Gensler, who was from the CFTC, as well as Bart Chilton was also. You did a recent excellent interview with Bart. Unfortunately, he's passed away, but Gensler was running these hearings, and by the way, he was the CFO of the Clinton campaign a couple of years back. But Gensler added, had Jeffrey Christian up, who is a very interesting character in the gold market as a consultant in terms of analyzing the gold and the silver market. He told a friend of mine directly that he had run Barrick's hedge book throughout the late 1990s. And if you look at the impact that the Barrick hedging program had throughout the entire gold industry, I mean, their hedge book was over 20 million ounces at one point that forward sold.
Didn't they lose a ton on that hedge?
Yeah, I mean, they did, but they ultimately covered in time that they didn't wipe out the company. But also, if you say that they lost a ton, perhaps in dollar amounts, but what happened was that many of the large producers started to hedge their production, were forward selling their production. And ultimately what you're doing is, what they did is provide future delivery of gold to the market. And the reason that future delivery of gold is important, if you look at Richard Pomboy's presentation at the Grants Fall Conference in 1997, I mean, he looked at the market and said, we've got 1,000 tons of occult gold or, invisible gold hitting this market here to balance the market out. And he had pointed out that there was a sub rosa central bank leasing program going on to meet this demand. Right. And that central bank leasing program would only have been possible with the forward selling of gold from the miners. And this feeds back into Jeffrey Christian again, is that his role there in running the hedge book for Barrick actually had a very, very deleterious impact on, the Barrick hedge book had a very deleterious impact on the market, on the gold market as a whole, because of the cascade of forward selling visible to the market, and also the invisible gold leasing by the central banks that was hitting the market and drilling it down. So, but Adrian Douglas, he stood up in 2010 at these CFTC hearings that were run by Gensler and said, you've got 100 times the amount of gold being traded in this market for which there is actual physical backing in the market. And he estimated at that point that there was about 2 billion ounces of gold in the market for which there was no backing. Unfortunately, we never saw the full details of that because he passed away from cancer he got very shortly after these hearings, he got cancer, and then 2 years later he passed away. But I mean, this is the issue here, is this pointing out by Adrian Douglas of the nature of the market in London. And the LBMA at that point was basically opaque. They posted nothing on their trading. But then 1 year later, after Adrian Douglas had stood up, the Alchemist, which is the magazine for the LBMA.
I did hear about that, and that title out of that institution always makes me giggle a little bit.
I mean, it's kind of mocking the market, isn't it? We're alchemists. But they don't turn lead into gold, they turn paper into gold.
Yep. I've wondered, I mean, the only way I could ever see this unfolding without a massive rise in the gold price is if they have figured out how to alchemize gold and silver, which I'm guessing they haven't. But other than that, I can't see a way.
Yeah. So 1 year later, the LBMA comes out with this, what they call the Loco London Liquidity Survey. So Loco London is metal that's settled in London. And in the survey, they say, okay, well, we've got responses from 36 of our 56 full-time, full members here on the LBMA. So that's about 64% participation in the survey. What they did not say was, does this include JPM? Does this include Goldman Sachs? Does it include all the major gold bullion bank players? Because it makes a difference. If you have 36 of 56 responding, if your big players are not responding to the survey, then it can give you very skewed numbers. But even so, at that time, they put out an estimate that it is in round numbers, that the daily trading of gold in London was of the order of about 10 times what they were posting in terms of net settled. So they post a net settled volume So if I buy 10 and sell 9, I get posted as having traded 1 contract a day. That's the net settled amount at the end of the day. And they basically, admitted to the fact that there was enormous trading volumes. And at that time, and shortly afterwards, it was about 250 million ounces a day of total turnover in that market, which is in round numbers about 2.5 times annual mine production.
Right.
So, I mean, this started this whole, he confirmed what Gata and so many other people had been saying about this opaque gold market. And we can see why the market has been opaque, because of, if you want to continue with the fiat money system that we have, and you want to run massive deficits and issue massive amounts of debt, you cannot have investors fleeing to assets such as gold and silver, which protect your savings in a time where they want to offer lower and lower interest rates and run the debt up to a higher and a higher level. And we've now, globally, we've got about 340%, 320% of GDP of total debt in the system, right? We've got $220 trillion globally of issued debt in the capital market. So that's how we've gotten to this point today. So the LBMA now is saying they have a transparency policy, and they started posting their figures. But now they're saying that they're trading 40 million ounces a day, down from over 250 million ounces in the 2011, 2012, 2013 timeframe. So I find it quite incredible that they could go, we've got 1/6 of the turnover in London. And the silver market is very interesting as well. And this, I know, is one that you follow very closely, Chris. And then when you look at they show what the open interest is. And the one that I find the most interesting is that there's about 1.9 billion ounces of forwards and swaps that are extant in the London and the Swiss markets. By the way, this new transparent data they give is an aggregate of London and Swiss trading for reasons I don't understand. But there goes back to that point on silver that you've been making in terms of the massive amount of leverage in that market. The spot is interesting. It's about 120 million ounces open, but it's the forwards and swaps, and these are physical contracts, right? I mean, these aren't COMEX contracts, right? You should be able to settle for metal in these markets, and I expect that someone expects to at some point settle for metal in those markets. So.
And are you familiar with these EFP contracts that we've heard quite a bit about over the past?
Yeah.
I think I got the gist of it, although if you could explain that and clear that up, I think a lot of people are confused on, is this essentially just more paper being added?
Indeterminate. I've looked at that over and over, and it's unclear, moving contracts from New York to London, and it's unclear to me what is going on. But by the way, that one point that we've talked about in terms of the failures to deliver, Jeff Christian in that interview that he did, or sorry, the statement that he made to the CFTC back then, he said that he was not concerned about fails to deliver in the market for physical. And he said the reason was, he gave a couple of reasons, but one of them was cash settlement.
Well, I love the semantics they use, where I'm guessing probably somewhere in the legal wording of the contract that is allowed, but at least in terms of reality, that's essentially a failure to deliver in my book.
Yeah, no, it's allowed by the CFTC rule book the COMEX rule book. You can read through there, and there's a number of provisions that allow the directors of the COMEX to force cash settlement.
Right.
But the point is that Christian's asked if he's concerned about a physical failure to deliver, and he says, I'm not worried about it because of cash settlement, which means I'm not concerned about a physical failure to deliver, because you can just have a physical failure to deliver.
And how do you think that would play out if that is the way this does go down? I mean, is it a matter of silver's trading 17 bucks, and we wake up on Monday, it's some multiple higher and you get 17 in cash while the actual physical is trading at 30 or 50 bucks?
Yeah, I think what happens is that your lease rate goes through the roof. I mean, and ultimately when you finally lose confidence in the markets, it's entirely possible that these contracts in London and New York can plunge in price because of a loss of confidence in these unallocated contract systems. If you're going to be buying COMEX contracts or buying a spot contract in London and you have no satisfaction that you're going to be able to get physical delivery, then you abandon the market and a new market springs up. Maybe it's the one in Hong Kong or the one in Singapore or Dubai. They become the focal point.
Yeah, and certainly interesting where you see new markets coming up. I mean, I maybe could see it more 10 years ago if people are saying, well, the US is strong, the systems are working, but I mean, it's now we actually see countries not just talking about it, but taking action, building infrastructure so that they are no longer as dependent upon the US. And actually, one thing you touched on in there that I'd love to get your opinion on, I know you do provide some, and by the way, anyone listening at home, if you're looking for lease rates and a lot of the data that is not easy to find, David, you provide a lot of that on your Twitter feed, so worth checking out at David Jensen. Anything you've been seeing in the lease rates with silver? Certainly if you're seeing anything now, perhaps if there was anything you remember from 2011 when the metal spiked that maybe we should be on the watch for, or anything with the lease rates?
Well, the gold and silver lease rates are negative right now, which indicate surplus in the market. Mm-hmm. And I'm flummoxed really when I look at both the new in air quotes transparent London data that they're putting out now. That their trading volume in gold should be a sixth, 1/6 today of what it was in 2011, 2012. And now seeing these falling lease rates as the price is moving up so sharply, I mean, it goes entirely against what should be happening, supply and demand, right? If your price is moving up, your supply should be tight, right? You have price increase due to shortage. And so
it's kind of like in 2008 when the price got smoked from 21 to 9 and there was a shortage there. A lot of unusual things happen in this market, don't they?
They do. And I mean, Bart Chilton talked about that, right? He was saying in the interview that you had with him that, there was things that were not totally on the up and up happening in that market. And that the difficulty that he faced was that the level of evidence was so stringent that it was impossible for them to start any kind of legal action while he was a CFTC commissioner, right? So, but he said very clearly, and both directly and indirectly, he was saying that, he was seeing things that he thought were wrong in the market. And this is why he continued to pursue it, is that he felt it was his duty to protect the markets when he was a commissioner, and that they he forced them to reconsider things and reanalyze things. And in the end, what they came up against was a extremely difficult balance of probabilities that they had to come, to meet. The evidence requirement was so strict that it was very difficult to get any kind of a resolution of these problems.
Yeah, and even taking that a step further, obviously a lot of people were blown away that he confirmed the Bear and JP Morgan short position. Although one of the things that you just touched on that I thought was stunning as well was that he mentioned the standard to get a manipulation conviction was incredibly high, but it bothered him so much that he actually had the standard changed. And while it couldn't be grandfathered, he was saying, I think if we had that standard in place, these guys would have been convicted Also thought it was interesting when I asked him if there's enough silver to settle the claims. He's like, no, but there's not enough in any of the commodity markets. Where I'm like, no.
Yeah. Well, I mean, in terms of the JP Morgan, the short position, I mean, you ultimately look at how JP Morgan performed during the great financial crisis, right? That they withheld the cash accounts from Lehman Brothers and triggered the failure of Lehman. And I mean, they just had to pay a $1.4 billion settlement to Lehman Brothers ex post, after Lehman Brothers had already failed, because they prevented Lehman Brothers from accessing their own cash accounts.
Yeah.
So, I mean, you can say, well, if they're willing to do things in that market, is there any limit in the other markets?
Yeah, and funny you mentioned Lehman and Bear. I was actually watching that movie Margin Call again last night, which apparently is based on an institution that's still in existence, according to the director, but certainly captures what you imagine things were like inside there in those last couple days.
You know what is funny, Chris, and maybe we can post that true money supply graph that I've posted there on Twitter, is that the great financial crisis in 2008 was caused by the Fed choking off money supply liquidity in the market after running a credit bubble for a decade. And they've done the same thing again. And in that movie Margin Call, there was one mention of the Fed. And ultimately, it wasn't this. And even Ben Bernanke has said this in several speeches. He says, you know, that the great financial crisis wasn't necessarily caused by the housing market, and it wasn't necessarily caused by a bank, but it was caused by a number of factors. And I think if you ultimately go back to looking at money supply liquidity, that is the key to the understanding the entire market, is that if you run a credit bubble and then take away monetary liquidity, you will implode that credit bubble.
Yes, we've seen that time and time again, and you and I talked about that a bit up in Vancouver, and certainly curious if you have any thoughts, again, as someone who's trying to short some of these stocks that seem completely insane, and then watching Shopify rise $10 by the day. You know, we've seen glimpses where last week we had the 800-point day down. You know, on the other hand, they have stopped the quantitative tightening, which I agree in the real sense. You know, on one hand, it doesn't matter, although for people who are looking at the stock market bubble, and we're not giving legal financial advice on the show, just sharing our opinion, but when do you think we start seeing this thing come down? You know, I've been wondering, I know the Fed's having their camping trip to Jackson Hole, and I'm guessing before the end of the week, I don't think they'll necessarily raise interest or cut interest rates this week, but I'm guessing there's going to be some Fed banker, you know, given Wall Street Journal the headlines that it's coming.
Yeah.
So what do you see happening in the broader stock market?
Well, I mean, the total credit in the U.S. system, according to the Federal Reserve, their Z1 flow of funds report is $72 trillion. And in 2016, the increase in the money supply was about 11% year over year. And starting in 2017 Q1, so that was 2016 that it was 11%. Q1 2017, they started to decrease it from 11%. And by the summer, it had bottomed at about 3%. We're now down to 2% year over year increase in the money supply. So money supply constrictions always hit the market with, 12 to 24 plus or minus months until it impacts it, because by reducing the money supply, you're drying out liquidity in the market, and it doesn't happen. There's a stock of money out there, and then there's the addition to the money stock, which is the money supply. And it takes a period of time to actually impact the markets. But we're now at that 24-month point in time now, which was the amount of time that it took in round numbers for the 2008 financial crisis to hit after they tightened up the money supply in 2008, 2007.
Right.
So, I mean, I'm waiting for this market correction to hit. And I think if you look at the NYSE Composite Index, which is a very broad measure of US equities, it's 2,000 stocks from micro cap right through to mega cap. If you look at that index, the markets let go in January 2018 and never recovered those highs again. And I think it's flagging down if you look at that chart. And so I think that there's something very, very close to happening now, Chris, and the equities will let go and then these central bankers will step in. But again, if we look at the last two financial crises or the market events in 2001, 2008, all of the interest rate reductions by the Fed in the last 20 years have been during these crises. There's been 23 different lowering of interest rate events, and all of them have happened as the markets have plummeted, and none of them have stopped the markets from losing half their value. So I think we're imminent now on it, Chris.
Yeah, and it's interesting. Again, the methodology with which I was trained at a really good options shop, they weren't, saying, look, because this happened at this pattern 10 years ago means it's going to happen there. Although to the degree that some of these things are engineered, and when you look back, there is a lot that often goes askew in September. Mm-hmm. I know there's some folks who, are looking at September, and certainly, I'm guessing we're seeing at least 50 basis points at the meeting, and who knows if there is anything else planned there. Although perhaps to wrap up, I know you have a couple things to take care of today, but the last one, hopefully to put a smile on the face of the people who are in the gold and silver investments. I guess it was one thing to keep gold and silver down when the Fed was giving the appearance of tightening, which I would dispute whether they actually ever did. Yet now when the whole narrative has changed, you already see gold and silver in the media. Now you have rate cuts. I'm guessing QE before the end of the year. It seems like in that environment, and it's not just in the U.S., you have it around the globe.
Yeah.
Do you think that, and are there perhaps any signs that you're looking for? But I mean, could this be at least the end of the bear market, whether that means we're about to see a rally that really stuns people, or just do we get to even $30 silver and $1,900 gold, or what do you see happening the rest of this year?
Well, I think there's enough signs, and there's so many articles now about, market experts that are calling for an imminent market correction, and even the major banks are starting to say it. And I just think that you get to a point, ultimately, in the end, when you're running a credit bubble, liquidity is everything. And if it's 1929, you look back at what happened then, is that the Fed took away liquidity. And all the studies, Ben Bernanke's and everybody else's studies look at what happened after 1929. But I think the key is to look beforehand as to what caused that bubble. And it was the blowing of a credit bubble and then taking away of liquidity. And so I think that's upon us right now. And I think it's interesting with the negative rates in Germany that you look at Munich Re. I believe it was a Bloomberg article 2 or 3 years ago that said that with the first negative rates in Germany, that Munich Re had started to vault pallets of cash and pallets of bullion bars. And it's interesting that Munich Re is not vaulting pallets of GLD share certificates. Right? I think they've got a good idea about what is going on in the market. So
maybe that's what the Fed has in their vault, and maybe wouldn't that be funny if someone actually maybe that's what Steve Mnuchin found in Fort Knox 2 years ago.
His comment was gold. Mnuchin said gold is safe when he came out of the Fort Knox vault. So
that was interesting as a student of neurolinguistic programming, paying attention to the actual words people use and how they phrase something.
Yeah.
He didn't say the gold is here. He said gold is safe, which, well, I knew that part.
Yeah, or our gold is here, right? So
he even said it would be quite a fantastic movie if the gold wasn't there. It was like one of the very few comments he made, and given his background and the skepticism around Fort Knox, I thought was highly inappropriate at the least. But
but so anyways, the bottom line here is that the pricing action that we're seeing in the market is I really look at it ultimately as being a bit of a Truman show, because you're following the price of promissory notes and you're not following the price of bullion itself. And I personally believe that when they start to, you've got 220 or 240 trillion of global debt, which they're now going to light on fire with quantitative easing and other tools of the central banks. You're going to see a repricing of these metals, and it's going to be based ultimately when these paper exchanges have an event. You're going to see a new price, and I think you're going to add at least a zero, maybe substantially more to the price. I think it's going to we're going to see metals remonetized. I think we're going to see gold remonetized by central governments and central banks. Ultimately, I think that citizens are going to remonetize silver. I think it's something that you're going to have people thinking independently and just saying that we're going to have a new, we're going to set our own price and our own value on these things. So very difficult to say anything based on charts. Silver has gone through its 200-week moving average now quite strongly, almost by $1. So that's 1,000 trading days. So, but again, it's these price charts, almost anything can happen with them as long as people keep believing in them and following them. I think they continue to be really deceived in terms of what's really going on. And I would just consider once again in closing what Munich Re did, and they were not buying certificates.
Yeah, well, I couldn't agree more. And again, there is a lot of stuff that's not quite as advertised, which is why I really appreciate you joining me today and sharing your insight and all the great experience and knowledge you have, so that at least people who are seeing this, or even the ones who aren't seeing it, can understand what's going on, make appropriate arrangements. I do no longer believe that this has to be the end of the world. I mean, I think people are counting on dollars, with there's a risk there, but to the degree that, we have a more honest currency system, that still it is people that build things and not banks. I like to think that, the more people are educated and see what's really going on, take action into their own hands, is a great thing. So I thank you for this. And perhaps just in wrapping up, you can let folks know one more time where to find you and anything else you'd like to pass along.
Yeah. Real David Jensen on Twitter is the handle where I post the statistics and things that I find that might be of interest. Ultimately, I think that the more people think for themselves and ask themselves if what they're being told makes sense, the quicker everybody will be able to sort this out. I started that process. It was kind of a disruptive process to me because I had gone through my entire life as an engineer, and I had done an MBA afterwards, and was following the Wall Street Journal, and believed efficient capital market theory and everything else I had been taught. And then you start to read a little bit of Austrian economics, then look at the markets, and you say, "Oh man, right? It's a bit of a mess." So I just encourage people to follow their own sense of reason and to use multiple sources, and they can sort it out. And think about what the major players are doing. They're starting to vote with their feet here and secure themselves for, basically a restructuring and a reordering of things. And the world won't come to an end, but it will certainly be a different world. And I think we'll look back upon these days, with a bit of a wry smile, perhaps.
Yeah, if only we could get you for president of the U.S. and chairman of the Fed, then perhaps we could help life go a little more smoothly. But until then, people can find you at Real David Jensen on Twitter. And again, I appreciate you joining me here. And We'll look forward to checking in soon. Should be fascinating to watch it all unfold. And again, just great catching up with you and appreciate all that you do, David.
Great. Thanks for your time, Chris.